Hey everybody, welcome to another Trader YouTube edition of As the World Turns. Today is Thursday, June 15th, all day long. Thanks for tuning in. Trading securities can involve high risk, loss of any potential funds invested. Any investment information provided by our user group may not be appropriate for all investors. Provided without respect individuals, blah, 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 blah. I give you this information without respect to your financial sophistication, which varies widely. Your financial situation, which varies even more widely, your time horizon, which most of you have is by the second, or risk tolerance, where a lot of you have none. But I give it to you anyway. And the information techniques presented by our users tended to be for educational purpose only, not intended to be a recommendation by selling a specific security, no matter what your rat brain is going to want you to do. Okay, let's jump into it this morning. A relatively quiet day, other than the fact that markets are selling off a little bit. Over in China, in the Asia Pacific area, we got data out yesterday that showed that most of China's retail sales and factory output it's not falling, it's not climbing, it's just kind of steady state, kind of like stuck in the muck a little bit. And they're having a huge property bubble there, and China's trying to do what they can do to cool that property bubble. It's going to probably be like the U.S. in 07 or 08, but not as severe, obviously. But China's trying to cool that a little bit. And the Chinese authorities are trying to reduce their financial system leverage, which they've really jacked that up a pretty good little bit too. So over in China, really nothing big, no big announcements coming out, no economic data other than just retail sales, factory outputs, kind of like it's a little bit resilient to some of the other things going on in China. But as I've always said, I do believe that should we get another big, huge down drop that's sustained over a week or two, the odds are even odds that China will be the one that will initiate it, or just issues in China. Okay, so that's kind of what's happening over there right now. Otherwise, really nothing else. The European markets have dropped to their lowest that they've seen in about 2 months. And some of the there's a number of different reasons being given, but I think the Feds yesterday kind of set everything running, and I think European investors or questioning the Janet Yellen, as we call her, aka Aunt B. They question her monetary policy as signs of consumer demand is starting to drop across Europe and in the U.S. as well. And also this morning at 7 a.m., Steve, we had the Bank of England. While they did not raise their rates, the vote was very tight. It was a 5-3 vote, meaning 5 votes to keep the rates where it is, 3 votes to raise the rates, and that kind of jolted the markets in Great Britain. It moved the pound higher. All currencies move, and debt and bonds move as a result of any central bank action. Sometimes it may move up and then down and then back to where it started, but it does create a lot of agita in the currency and the debt market when any central bank comes out with any decision, even if the decision is to do nothing, like Bank of England, but it was a 5-3 vote, meaning now it's getting tighter and tighter. So the markets interpret that as, well, that means because of that tight vote, the odds favor a rate hike possibly this year. And the UK sales fell, getting a report early this morning, 1.2% in May, versus the forecast of a fall of 80 basis points. So like the US here, with retail sales falling, flagging consumer demand, yet the central banks are talking about, starting to withhold the blueberry pie and making it more tart. And little kids don't like that. They love sweets. They love candy. So the central banks are going to have a little bit of a tough a go of it over the next 3 or 4 years, cutting balance sheets, raising rates or at least stopping the stimulus, it's going to make for, I think, a higher volatile environment over the next 2 or 3 years. For us, that's a good thing, right? Using options as our primary tool, higher volatility, actually works to our advantage. So that is what's going on over in Europe, and that 7 a.m. bump up and down depending on which asset you're trading and what your directional bias is. That's what caused it. So just as a heads up, any major central bank, and there's only just a few, Bank of Japan, the BOJ, the PBOC, the People's Bank of China, and I always say this, why they call it the People's Bank. Why is it every communist country, when they name something in the government, they call it the People's? The people there have nothing to do with it, but it's a soundbite that makes the dumbass citizens feel like the government's doing it for us, when in reality they do it for somebody else. Kind of reminds you of some political parties here in the U.S., doesn't it? That's communist, buddies. That's fascism. That's socialism. But anyway, I digress. The People's Bank of China, the Bank of England, as we saw this morning at 7 a.m., the ECB, which makes up 19 countries. Now, 19 countries don't have central banks. We just follow one, the ECB. And then, of course, our illustrious Feds, headed by Janet Yellen, a.k.a. Aunt B. You need to mark on your calendars, or at least know when each of these central banks is going to have a policy statement. They do it every month, and then there's 2 months out of the year that they skip. Like after this month, in June, I believe they will skip July and go into August, September. They'll have a month off, and then they'll do it again. And if you're in a currency, or you're in bonds, or in any kind of debt instrument, or any equity, you need to be aware of these central bank policies, because they'll affect you now more than ever. Doesn't matter whether it's Chinese banks, Japanese central bank, Great Britain's central bank, the European Union, the ECB. It doesn't matter. It's a global market, and all markets are affected. So that's what happened this morning at 7 a.m. And if we come over here and turn our attention to the U.S., we got our central bank notice yesterday. Illustrious Janet Yellen stepped up to the podium at 2:30. If you remember at 2 p.m. when the policy came out, the markets really didn't move that much. I mean, they just kind of hovered around flatline because they were waiting for Yellen. Everybody had forecasted in the CME tool that the 30-day Fed Fund futures priced in like a 98 or 99% chance of a rate hike. So the markets didn't move much. But then at 2:30, when she started talking, and then people started analyzing the policy statement and everything else, the market started to react a little bit more. And remember, that was 2:30 p.m. All other markets were closed. The European market, except the futures, but the European market, the Chinese, the Asian Pacific market. So when they opened this morning, their reaction is happening today. And a lot of their reaction, what do? They're holding U.S. bonds. They're holding U.S. equities, so they go in and they react accordingly. They're holding U.S. dollars. They react accordingly. So we get a movement in overnight hours based on what their reaction was to the Fed when their markets open early this morning. So you've got this daisy chain. You know, you start pulling the thread on your sleeve, and next thing you know, the sleeve falls off, then the jacket shoulder pads fall out, and you don't have a jacket anymore. But that's what happened. So anyway, Aunt B came out yesterday and said what she said. And it looks like the market, the global markets, here in the U.S. too, the primary takeaway was that the Feds, according to Janet Yellen, expects economic data, mainly inflation, because that's where the global focus is right now, to rebound soon. And when it does rebound, then the Feds are going to continue with their rate hike. However, if you look at the Fed funds tool and the Fed fund futures, the markets remain more skeptical. The markets have only priced in about a 50% probability of a rate hike in either September or December. Remember, we got a couple more Fed meetings before September, but the Feds, you know, not since the 90s have they hiked rates that don't coincide with a quarter end. And the reason why they like to hike the rates on a quarter end is or cut the rates on at a quarter end, is that's when the Fed chair, in this case Aunt B, gets a chance to do her press conference. She holds 4 of them a year at the end of each quarter. But the markets are only pricing in a 50% probability. Yet the Feds are saying they're going to do one more rate hike. So who's going to be right? The markets haven't really priced in another rate hike. It's 50%, 50-50. And Yellen is on record yesterday as saying that she's going to pay a lot of attention to inflationary data. That would be the CPI data. That both at the wholesale level, that was the PPI data, producer price index, or at the or at the retail level, that would be the CPI data, or retail sales, which is 70% of the U.S. consumer spending. So what that really means is now the market over the next, let's say 60 days, over the next 2 months is going to be watching very closely CPI data, market data. And when I say the market, I mean the big money is going to be watching that very closely. And if that comes in and it shows inflation's not going anywhere, then that discounts a lot of what Yellen is saying. So there's going to be a battle going on. And it means the market is going to be focusing even more intently on the incoming data, specifically the inflation-related stuff. So that's our interpretation, my interpretation, and a lot of the big money interpretation of what Aunt B said yesterday. So she is being a little bit more hawkish than what the markets were expecting. So she did not deliver really a very sweet blueberry pie with loads of fat and butter and sugar and everything else, right? So that is kind of where we're looking at. Yeah, Karen, we'll take a look at that chart in a minute, okay? As soon as we get into it, I'll take a look at it. Sounds cool. So net, that's what we're looking at today, okay, as we start the day. If we look at the data coming out, let's go to Thursday, right? That's where we are. You can see this morning, Thursday at 7 a.m., we had the Bank of England interest rate decision. They didn't touch it, but like I said, the vote was a lot tighter and a lot closer than people thought, 5-3. 3 wanted to hike the rates. That's a close vote. That's why the pound went up, even though they didn't hike the rates, because the pound, basically, the markets is interpreting that as more of a hawkish, let's raise the rate statement than a dovish statement. Now tonight, we get Bank of Japan and their monetary policy statement. That'll affect the yen. That'll affect big money. That'll affect the Japanese sovereign wealth fund, which, by the way, is buying equities as part of their charter or selling equities and buying bonds, U.S. bonds. That, remember, Japan is the second largest purchaser of U.S. bonds behind China. Well, actually, the largest purchaser is the U.S., but then behind the U.S. is China and then Japan. So this affects you guys. Whenever you see when I do a weekly market watch Sunday nights or on Tuesdays and Thursdays, I always cover what's coming up for the week. But the key things I kind of highlight with a yellow highlight marker there. And when you, like this week, I said this week, this Wednesday and Thursday, it's nothing but central banks. So you're going to get a lot of chop in the debt market, and you're going to get a lot of chop in the currency market. And then that in turn will influence the equity market. It doesn't go the other way around. You don't see equities move and then currencies and bonds. It's the other way. Currencies move and debt moves, which then affects the equities, because big money is moving in and out of debt and currencies into equities or out of equities into more debt or currencies, all right? So because the currency market and the debt market is like 5-10 times bigger than the equity market. So you got to know where's the dog and where's the tail. And the big dog in this hunt is currencies and debt, and then the tail is equities. But if you only focus your time on trading the tail and you're a tick at the end of the tail, sometimes you get dizzy because the dumbass dog's chasing his tail. And you're a tick and you think you control where that dog goes, and you're trying to trade the tail. And yet you look up, and if you had a wider macro view, you could see, well, if that dumbass rat brain owner of that dog would stop making that dog chase its tail, maybe we'll get some more sensibility here. And that dumbass owner is the central banks. Oh man, yeah, I know my analogies. My analogies get out there a little bit, but you understand what I'm talking about, right? Most people that jump into trading, and especially just stock only, you just focus only on stock, which is why I was one of the first guys back in 2008 to get the retail trader to start focusing on Japanese bonds and Chinese bonds and European bonds and currencies. And you're like, I don't need ever trade that stuff, so why focus on it? And the focus can be just merely to watch the reports to see whether it's bullish, dovish, or neutral, because that will move equity markets everywhere. Of course, the U.S. central banks affect it more than others. Okay, so that's a little bit about what we got there. So let's go take a look at the charts. And as always, we're going to do the equity or the indexes first, and then volatility, currencies, debt, and the major commodities. But if you have a stock, as I always say, that you want me to take a look at, then, just put it in the chat. And then, if we got time to look at it, it's always first come, first serve. I'll look at it. All right. So let me just freeze the screen for a second. And let's go into it. So bear with me 1 second here. As I move things around on my screen. All right, screen's coming up here. Let me get everything done here. All right, I'm going to get the first indexes first we'll cover. Let's go take a look at the S&P 500. And I've got a 2-hour chart up here, okay? So you can see on this 2-hour chart, this was, as I said, the big range. I posted this chart in the chat room the other day. That was the all-time highs, and if you can't see the number there, it's basically, let's just call it 2012, which is that key pivot there that we had last Friday's pivot low before the markets moved up. And this is more a bearish sign than a bullish sign, guys, because when you come up and you have a double top and then you sell off, we're right on that big, longer term, what we call an upsloping trend line, right? So if that breaks, which I suspect it could very easily, we'll come down and test this level. This would be my S1 level, or what I call the first level of support, all right, at 2012. I'm not sorry, 2412, not 2012, 2412. Okay, once that, if that stops, then I would come in here and I would look at that. If it doesn't work out, we've got another pivot level here. And as I just move this up, you can see here, I've got the key pivot levels on this 2-hour chart. Next up, 2400, okay, on the chart here for the S&P 500. If I put everything back on the, if I've got everything here, you can see that each of these pivot levels are going to mean something to us because these are prior pivot lows. So anytime you got a movement up in the markets, right, and the markets are moving higher, but it has some consolidation, it moves up, it has some consolidation, it moves up like that. It's forming a series of lower pivot lows, or higher pivot lows rather, and you can connect the dots and you've got an upsloping trend line. You can see this upsloping trend line that connects this guy here, and this guy here is slightly got a higher vector. That has a slightly higher vector than that one there, right? And as you go further out in time, you'll have a separation between these two. So that's why I believe that's going to probably go by the wayside, and we'll probably come down here to this area right here, okay? The projected Elliott wave count in my system says we can come back down to here around 2375, okay, over the near term. And the near term would be June and July. Because think about it, guys, June and July is the worst month statistically going back the last two decades, which is 20 years. The month of July is the one where the markets tend to fall the most, right? The SPX. And where the SPX goes, most other equities tend to follow, except risk-off type equities like utilities, staples, maybe even healthcare a little bit. All right. So we'll start to see that if we start to break these down, and the markets will start to get a little bit more in a downward trajectory. I do not believe we're going to be in a mass sell-off, more than 5 to 7% at this time. If we start taking out more key levels, then I will look at that and say, okay, that could happen. If we look at the daily chart, I've got a lot going on the screen, but let me just take some of this stuff off and clear it up for you. I've left on the screen the key Fibonacci levels. And these key Fibonacci levels are extremely important. I'm going to put it back on a weekly chart, and you can map them on your chart as well. Going back on a weekly chart, and we look at this time frame right here, right? Let me just kind of zero in on this time frame right here. Okay. And this goes back right here. That right there is the beginning of 2015. All right. So this is 2015. So we're going back a few years. All right. So this is 2015 where we kicked off. And then we stayed in a wider range, right? For quite some time, actually. So if I measure that range and I just take the high minus the low, okay? That is about a 333 point range of the S&P, all right? 333 points. And we were in it, really, technically, we were in that 333 point range here for about that time frame right there, okay? So at the beginning of 2015 to the beginning of 2016. So that was a 1 year range, all right? That was 1 year. And in that range, it took us over a year. We hit the highs here in May of 2015. And then we didn't come back and revisit these highs until the end of May, early July of 2016. And it was a record for the market. When the market hits a high and then it takes a long time to take that high out, it's a record, because most highs, believe it or not, are taken out within a 12-month period. This one took a long time. So this high point right there became a key pivot high, all right? This low point right there became a key pivot low of this 333 point range. So when I say I'm doing a Fibonacci extension, because remember, once we took out that high right there, we'd never been up at these levels before. And you got to say, well, gee, where is the resistance level when you go to an area where you've never been before on a chart? And the way you do that is you use Fibonacci extension tools, not retracement tools. Extension, because we're extending off the high pivot point, right? So once we extend off that high pivot point, we use the same Fibonacci key numbers and key variables that we use for retracement. So you design that as the pivot high, you design that as the pivot low, it defines it as 333 points, and then it takes percentages of this 333 points and it tacks it on right here and it adds it up. So you get a 23% level right there. You get a 38% level right there. You get a 50% level right there. You get a 61% level roughly right there. You get a 200%, which would be 100% level right there, like that. And those percentage points just measure the percentage of that gap between the high and the low. So that is what a Fibonacci extension does. And these here, and you may go, well, gee, why the hell does it work like that? What's the magic and the magic 8-ball science behind that? The magic 8-ball science behind that is what we call 8-ball science. And this 8-ball science is the innate human condition of fear and greed, where profits tend to be taken, where buyers tend to come in, where sellers tend to come in. Fibonacci is based on that. And I'm not going to go into the details behind Fibonacci, but it's really an interesting read. If you Google Fibonacci and the founding of Fibonacci. It's really interesting. And you'll see that a lot of architecture in the U.S., a lot of science and nature runs on these key ratios. And human condition is designed around these key ratios, right? It's amazing. And it's no different, because when you look at buying and selling, it's all based on fear and greed and human condition. Human conditions drives profits higher. Human condition sells. And price action is a reflection of the characteristics of the people that are trading, right? So when markets are running higher, the characteristics and the adrenaline, that's why you get markets that always overextend to the upside and fall further to the downside, because it's human reaction to it, right? Or panic. And for us, trying to be non-rat brain traders, we take advantage of that. We're sadistic bastards where we go, okay, we will take advantage of your fear and your greed, and we will exploit it to our advantage. And that's what the professional traders do. That's what rat brain traders don't do. That's what we try and do. That's why I always harp on that. And because we're all human, we all have rat brain tendencies, and it's hard to fight, but as long as you're aware of it, then you can fight it. So nonetheless, these generate these Fibonacci retracement tools and you can see even in this area here with Fibonacci, when we broke out of that key pivot high, which was right in that area there, we knew that we would get some resistance right here, resistance right there, and or support, right? And then right there. Remember, these are weekly bars. We spent 3 weeks there. We spent 1, 2, 3, 4, 5, 6, 7, 8 weeks there, 2 months. Right here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. And we came back 12, 13, 14 weeks there. So it's no mystery that if I didn't have any of this drawn on the chart and it was all black, meaning we've never been up here before, and I say, okay, plot where you think we're going to find a lot of resistance. And you'd say, well, hell, I don't know. We've never been there before. And you lay the Fibonacci on and you say, okay, I can give you better than 50% odds where we're going to have our resistance and support. That's what Fibonacci extension is. Also notice right there we spent 3 weeks. Right there we spent 8 weeks. Right here it was about 14 weeks. What does that tell you? The higher we go, the more resistance we find. So as you become really good at reading charts, you're going to be able to plot where we can expect. I didn't say where you will get, but where we can expect resistance. And then we play that to our advantage. And then that gives us anywhere from about a 55 to a 65% edge over the rat brain trader and a lot of other traders, right? And that's all we need. And then with this edge here, assuming you know how to manage your risk, if you put the rat brain in their cage, then you'll be able to manage risk and you'll be able to do this. So part of your goal as you're trading and you're learning options, do not forget about chart bias and charting skills, because I don't care how good you are at strategies and how well you understand a specific option strategy. If you can't interpret a chart accurately, you may go in and say, well, I'm bullish, and yet the chart says you shouldn't be bullish, you should be cautious. In fact, you should be bearish. And you'll go into an option strategy that you're fighting the minute you put the trade on. And you guys know those strategies. We've all been there. You put on a strategy, and within a day, you're fighting that strategy. And you're fighting, and you're fighting, and you're doing adjustments, and finally you say, screw it, I'm out of it, right? And 90 times out of 100, it's because you interpreted the chart wrong. Now, if you're right, or even if you're just a little bit right, then you've got enough skill set in your learning here that you can take an option trade and you can make minor adjustments and stay in the trade and make some money and then get out of it, right? So this is all about just a little bit of my philosophy on some of this crap and using charting skills. So this is a weekly chart. If we come back into a daily chart, right, and we look at this superimposed with all the Fibonacci's on here, right, you can see this is a key level right here. You can see we lay some other things on the chart. That's all volume at this price level. So you can see most of the volume has happened around this price level here. and the Fibonacci is kind of providing a little bit of support, right? It's always, it's a zone. We're looking at the zone here, not a specific 2341.85, but we're looking at the zone here is kind of what we're looking at. And we've also got overlaid on this chart a 345 Elliott wave pattern, which suggests the Elliott wave 5 is traditionally the end of a near-term trend, or the trend on the chart time frame you're looking at, which would be daily, and then that would just mean we could get into an ABC pattern like this, and then this ABC pattern is going to help us determine these pivot highs and lows on the A leg, the B leg, and the C leg on a daily chart, because this is a daily chart. Where can we go? And then we throw in the 50 EMA, the 200 EMA, and then we start to paint a picture of near-term bias on a daily chart. Remember, a daily chart takes us out about 30 days, which is 30 bars. Right? That's kind of where we're going. Once you start getting out here, all bets are off. You want to kind of guesstimate where the odds favor right here. And this right here, if it's a 1-minute chart, could just mean the next 20 minutes. If it's a daily chart, it could mean the next day, right? And then because the market and charts are fractal, meaning, okay, we're looking at the daily, but then we'll go from the weekly down to the daily, down to a 2-hour chart, down to, I like to go from a 2-hour down to a 15-minute chart, then a 3-minute chart, and then you can come into a tick chart if you want. And you'll see other people may not use the 2-hour. They may use 138 minutes. They may use a 32-minute. They may use a 1-minute. They may use a 386 tick chart. That means every 386 ticks it prints a bar. They may use a 1.5 days. They may use, I don't know, a 4.5 instead of a pure week. So you get all of these odd ones here like this. And that's okay. You can do that. But if you do this, you've got to stick with it. If you use this, you got to stick with it. And it does not, I promise you, give you a statistical edge to come up with an 8-ball number that's different than the standard right here. A lot of people do this only because their platform lets them do it, and it makes them sound really cool, and they're not. It doesn't give them a statistical advantage over this one right here, right? It's not, but it just, it's good talking points, and they use it to sell their shit. But that's kind of what it is, right? I stick with the standard, and the standard has served me very well. Now, if you are a day trader, then you will probably spend your time down in the lower time frames, like right here. If you're using option trade, swing trading, you'll probably spend your time either in a 2-hour and a 15-minute looking at the daily to kind of help set the tone. If you're a little bit longer term, like let's say stocks where you're going to own, you'll probably spend your time here weekly, daily, and you use the 2-hour for an entry and an exit, okay? So that's a little bit about just some of the charting here that I wanted to emphasize with you guys. Let me just get my chart back up here full screen. So that's what we're looking at. So I come back into the 2-hour chart. We look at this, and you can see clearly here on this 2-hour chart. Let me put everything back on the screen again. Always on your charts, label the 2017, each year's high, each year's low, and each year's open price, because those are what I call rat brain headline numbers. Anytime the markets make a new high, it goes into the rat brain business journal of the day, which is the National Enquirer or the USA Today color by numbers newspaper. All right. Anytime the markets go through the yearly open price and goes into the red, that's a headline number. Anytime it makes a low for the year, that's a headline number. Color these on your chart. Because you can see right here, we came right up and kissed it and fell right back down again. That's the market's way of saying we're just going to suck some more people in, and then we're going to drop right back down again. I believe we're going to go lower. I've said that. I said we're in a buy on the dip also. So the dip's not over, by the way. We're still running down. And if we make a lower low from this low here, and we come down here, we make a lower low somewhere down there. Notice the MACD. We're not going to get a bullish divergence this time. If the MACD was somewhere up there and it was bouncing and starting to roll there and we were going to get a bullish divergence, that would be a bud, right? Or I would say how many crosses. We got 1 cross, 2 cross, 3 cross, and then if we had the magical cross right there, that would be 4 crosses. This would be 5. That would be 5 crosses. That would be what I call a poor man's bud. You still have a statistical advantage, but not the ideal. It's still a 5 cross thing, but if we start to get a movement up like that, that means we got a cross down in this area here, which means we do not have a bud, which then tells me that any up move here is going to be a bull trap and it's going to roll back over again. All right, and until I'm proven wrong, that's the way we play it. So this is just chart interpretation. So that is the E-minis. If we look at the NASDAQ, which is starting to feel the heat, right? NASDAQ is down almost 65 points, and we haven't opened the market yet. Excuse me. Well, that chart don't look right. Here we go. I must be having internet problems here. Let me just see if I can put it on a daily here for a second, see if I can flesh it out. And let's come back to a 2-hour chart. Sometimes I'm having some of these time frames just, it's really weird. So let's go back to a daily. But here's the NASDAQ. We're going to come to a moment of truth in the NASDAQ, right? You could see it better on a 2-hour chart, but I guess I won't be able to get it shown right now, this damn thing. You can see just barely right there, I've got a little colored bar. That colored bar was generated on the 2-hour chart, which also gave us it was our resistance point, gave us our all-time highs. And now look at us. We had one test of the 50 EMA. We're probably going to test it again right there. We've got one cross here, one cross there, one cross there. But the issue is it's not a bearish divergence. If I were to draw the line straight across, it's zero bid. All right. So ideally, if the MACD would have come down and come up and given us some more of a bid, I'd been more bearish the NASDAQ. So without a bid, a bearish divergence, this just means that this is still a buy the dip kind of thing, right? So this could be, in the scheme of things, a bull flag, where the odds favor a break to the upside, okay? But we're not done with the downside action yet. And if we break the 50 EMA, we're going lower, right? We are going lower. And if I move this out, you can see the separation here between the 200 EMA, the 50 EMA, and then you got the 12 and the 4. The 4 is beneath the 12, so that would be your first signal to say either get out or look at more of a short situation here. Okay, now we've been in and out of the NASDAQ, and we had a really good day. We played that one to the downside and had a really great day. If this breaks right here, we'll probably have a fast run down here, so we'll look at shorting the NASDAQ again, right? Or using options and playing the Qs. And just doing just like we did in IWM, but we played the Qs to the downside. It's probably not as risky as playing the futures, because the futures is $20 a point, and we're already down 64 points right now in the market. Let's look at the Russell. The Russell is down almost 14 points. Now, you heard me say I was going to hold up on the Russell. I want to do a new rut trade. I want to do a new superfly trade. Right? Not a super bird, but a super fly. Higher volatility. As long as we're falling, I'm going to sit on the sidelines until we get our first uptick and a downtick in volatility. Higher volatility is a good time to put on a super fly. Okay? It works to our advantage. So as long as we're falling, then I'm just going to sit on my hands or my ass and wait until we get an uptick in equities and a downtick in vol. It's just going to take one day, and that's when we'll slap on a new superfly and a new rut superfly. And I will do it, and in fact, in the rut and the fly, or the SPX, I may do it as a accordion fly. All right, we haven't done that in a while, but I like doing it when volatility is rising. And I'm going to do it really small lot size so you guys can follow along with me. For those of you in portfolio margin, I've got 8 tranches now that are active in a super bird, which is performing as advertised. And we got the FUBAR hedge. I've got 8 tranches. Some of you may have little bit more. Some of you may have a little bit less. Remember the ratios in the Super Bird for those of you in portfolio margin. I'm going to be adding more. I'm going to be adding more videos to the video library. Not next week, but the week after, I'm going to be in the process of finalizing my opening of my other office down in Florida. So I'm going to be down in Florida, and I will, I'm going to be in and out of the chat room for a couple of days, different days during the week as I finalize my office opening. I always try and do this kind of stuff in the summer when most people are off on vacation or thinking about vacations, or the markets, the volume comes down a little bit. All right, so if we look at the volatility, well, the VIX is going to move up. All right, we're still in the green. We hit a 2017 low in VIX. You might not realize this, but we hit a 2017 low in VIX on June the 9th, just a few days ago, right? 6 days ago. We hit lows that we haven't seen in 2 decades. And now we're up to 1191. Big whoop. We're still in the green zone of volatility. All right. And just so that you know, anything in the green zone, the market is still relatively complacent, even though we're getting a little bit of a pullback here today. The markets are still relatively complacent. I will tell you, though, that you can move in a day or two. Remember, we are sitting right here right now, and from that point right there, in that same day, we were right up there. It does not take long to go from here to here, and by the same token, it does not take long to go from anywhere in this area here to anywhere in this area here. It does not take long at all. All right. So just understand that. I do not believe we're going to get into the zone 3 area. I think we're going to stay in the upper boundary of zone 1, possibly into zone 2 with volatility. I don't see any existential threat. The only one that I see, which would be a catastrophe for the markets, is North Korea. And so, but outside of that, I just don't see the markets coming undone. The only thing that would make the markets come undone is if Trump gets into trouble, none of these policies come through, and then we're going to have a recalibration of the markets back to the way the markets were pre-election, all right? And just to remind you, if that happens and the markets fall back to pre-election, just to give you an idea where that is, right? It won't go to the U.S. presidential lows, but it was 2028 on the eve of on the night of the election. You guys, for those of you that were members, remember we were trading this and we made some really great money. And for those of you that were fortunate enough with me, when we went long the Dow at 17,750 in the Dow futures. All right. Now I got chopped out about a week or two later, but it was about a $4,000 or $5,000 per contract win, right? But this is where we're headed, guys. If Trump really literally fails, or the Democrats get their way of obstructing everything, and in this I think this mock kangaroo court going after him for all this stuff, which is just another way to slow down the agenda. This is where we're going to end up. All right. So just understand that we're not going to end up here unless that starts to unravel. And the markets are getting a little bit scared of it, but we will know that before we even get down there, right? You'll see there's key areas here that we would need to take out. My first line in the sand is going to be around the 2300 area, down in this area here. If we break 2341, which is that fib node, remember we're at 2427 right now, so you're looking at what, about 80 points south of where we are. Keep in mind, we can go down 80 points in the E-minis in less than 2 days. It doesn't take long to get there. And it doesn't take long to take volatility and go up to zone 2 or 3. I mean, as you saw, 1 day is all you need, or 2 days to move 80 points. We can move 5% in 1 day before the market shut down and lock prices up in aftermarket. During market hours, it's a 7% drop. So if you take 7% of the current price, That's 169 points. All right. We had that scenario right here on the presidential election. All right. We had the markets fall over 100 points in overnight hours, and then the markets locked up. And then when they opened back up again, the markets bounced. But I've seen days where the markets have locked up for a couple of days in a row, and you're down 200 points before you can even say boo. All right. So and it's not, none of this is to scare you. I don't see that happening, but it's to let you know that it can happen, and you've always got to have yourself under control, and you've got to watch your position sizes. So this is where we are right now on this. Let's go out and look at some of the other commodities here. Let's look at bonds first. All right, so if we look at bonds right here, we made a new 2017 high with the Feds. And then right at this level here, remember, we traded in the bond market. I've been in and out. We were trading that little pattern there. It's like a little bull flag. And then boom, we broke out up here. And then I started just taking some small shorts here to have it revert somewhere back to the mean right here again. Okay. So that's why I entered a short last night. And I think some of you jumped in. I saw some of you out there. But I just entered the short, put my buy stop out there. If we come into a 2-hour chart, you can see here the normal consequence of that. Okay. You can see the high up here, the 2017 high. This again too is a bull flag. You kind of look like that right there, and there's the flag. They call it a flag because it looks like a flag pattern. Okay. The odds favor a break to the upside on a flag pattern. If it does that, we're going to get more downside action in the equities. But last night I came in and I shorted it up here, and it's just kind of come down. So we're making money in our short from last night. We're just trading these little counter trend moves, right? And if the flag pattern breaks to the downside, the odds don't favor it. But if it does, it'll fall really quick and take us back down here. And then we'll end up taking a $300 or $400 gain per contract and turning it into about a $1,500 gain per contract. Okay. But set your buy stops on your shorts so that at least you can break even or make a little bit of money should the pattern start to develop and break out. All right, so that's a little bit about in the bond market. If we come in and take it to a 15-minute pattern here like this, you can see why I came in here and I set the stop. My original stop was at 156.07. I wanted to make the markets take me out, and then we just had all this overnight chop. And then as we started early this morning, and then you can see right at 7 a.m., the bond market reacted to the Bank of England, right? This is 7 a.m. bar right there, and you can see how the bond market did a big sell-off. Now, that wasn't American traders in there. That was British and European money. And now it's starting to make its way back from that initial sell-off, right? And then it's going to come up here and it's going to have a moment of truth and say, do I want to continue my run higher, or do I want to go a little bit lower right there, right? Meanwhile, my original stop up here at 156.07, and you would read that as 7:30 seconds because the bond market's really screwy. It doesn't have 156.25 going up to 156.99, and then it goes to 157. It does it in increments of 30 seconds. 1 30-second, 2 30-second. So I set my buy stop right here on my short, and the minute we started moving down here, I rolled it down, and now I'm sitting somewhere around here on my buy stop, so that at least I've got profits. If I'm taking out, it's just a small little scratch trade where I make a little bit of money, but we may come up and roll back down again. The odds and the pattern on the larger time frame would suggest we're coming back higher. So anyway, I've also seen markets that panic, and then you have a sell-off in equity and debt. And that's when that tells me that the markets are due to go even lower, right? So this is where I am with the bond market, and that was a little bit about my explanation for doing some of these shorts, right? So that's a little bit about the bonds. If we come in here and we look at currencies, you will see the US dollar is up, right? This is what's really strange, right? Here was the dollar at the dollar had excuse me, the dollar had sold off. It moved up on the Fed announce, came down, and then it's kind of like this elongated cup and saucer pattern. And then if you do this break right here, it would suggest that the distance up here on where it can go to is going to be equal to this distance right there, roughly. Okay, that would be the pattern analysis, and that would suggest that as the dollar goes up, bonds is going to go down. Okay, and you can see here that if you look at the pattern of the bond market, and then you look at right at the 2 o'clock time frame, right here, the dollar was selling off, right? This is the dollar, and right up until right there, that was the pattern. And then we got the Fed announce right here. And then away we go like that, which tends to be more, anytime it's a little bit more hawkish, you can look at the dollar. So just as a rule of thumb for you guys to say, well, hey, was that announcement interpreted as hawkish, neutral, or dovish? Look at the bond market and look at the US dollar. And if the dollar moves up, it's a little, the higher the dollar goes, the more hawkish their announcement. The lower the dollar goes, the more dovish the announcement. And then if it kind of stays in this no man's land, which is kind of what it's doing now, the market is kind of saying, okay, well, it held up, it didn't fall, so it's not dovish. It's not necessarily very hawkish. It's kind of like trying to thread the needle there, which is what Yellen, aka Aunt B, likes to do. Remember, you can read that statement until your eyes bleed, and it's not going to tell you whether it's hawkish or dovish. You'll draw an opinion and an inference that it sounds hawkish or it sounds dovish, but let the price action tell you, all right? Because the price action is what rules the roost for us for trading. So that's the US dollar. If we come in and we look at metals, let's look at gold. Gold is having a bad few days. Gold's down 20 points before the market opens. This is the 15-minute chart. Now we're getting a 3, 4, 5 leg, which would suggest, but this is going to be a poor man's bud, it would suggest that we're getting closer to the bottom in gold. If we look at it on a daily chart, first of all, you can see here that we are now sitting right around the 200 EMA. We did get across to the 50 and the 200 right here, right? And we haven't had that cross for quite some time. So that would suggest gold wants to go higher. But remember, this is the other asset you want to look at to interpret the Fed action. If gold moves down, that's more of a hawkish interpretation in the gold market of the Feds. So I've already said the dollar is neutral to slightly hawkish. Gold is interpreted as hawkish. The bond market, while it moved up a little bit, is kind of sitting there, kind of off a little bit. If the bond market decides to be hawkish, they will go down. But the bond market has got other things that it's also looking at, which is inflation. Same thing with gold. With lower inflation and a hawkish Fed, gold should be back down in this area right here. All right, so that's kind of where we are with gold. And also we've got that the 3 leg, the 4 leg, and the 5 leg. So we're in this ABC chop pattern, and this will say wherever the pivot point for the A leg, the B leg, and the C leg is going to say, well, does that mean we're going to go, which direction are we going to go? So as you can see on a daily chart, we play it a bar at a time, but each bar gives us a new data input into, you know, where is it going to go? And right now, to me, it's still suggesting lower. All right, I was surprised that we got all the way up to here. I thought we would roll over right there, but we overextended like the markets always love to do, and now we're peeling off a little bit. So the bonds are down over 20 points right now. And then if you look at GDX, I guarantee you GDX is not going to have a pretty day, right? That was yesterday's GDX. If we look at pre-market, GDX closed yesterday at what, 22.22. It's going to open at probably 22 right now. You can see the sell-off in pre-market on GDX, so that's going down. Silver Silver's doing the same thing. Let's go back to the daily chart. So silver, again, is probably a little bit weaker than gold, right? And you can see it rolling off the table. So again, I'm not ready to go long yet, these guys. Let's look at oil. Our trade is profitable right now, but what is oil doing? Kind of what I said I felt it was going to do. I said, even when Goldman Sachs came out up here and said oil is going to the low to mid 60s, what did I say? And what did I say we should be thinking about? It's probably going to come down and test these lows here. And I've been saying it with every bar that we've been moving lower like that. And that's kind of where we're doing, right? And we've got a new Elliott Wave 3 that would suggest we can go even lower. I don't know about that just yet, but I do know that the way we're taking the trade, over the next 3 or 4 days, we should be okay. I don't think we're going to get another jolt to the system like we got yesterday. That oil inventory report was interpreted as very bearish for oil. If we come in and look at a 15-minute chart, we'll zoom in a little bit. You can see that oil inventory report, bam! And now we're sitting here in a quiet period. And all we need for this quiet period is for it to last for a few days, another 2 or 3 days, over the weekend into Monday or Tuesday, and then we're out of the trade for more profits again, right? And we added to the trade. Because we held our trade during the oil inventory report, I held it because the pattern here in oil was like this, and we were like this, and we were almost right in the center. So that's why I held it for this big move to the downside right here, because we were right in the center. If we were skewed one way or the other, like we were, I did those selling puts and selling calls to get us back into the center. Those adjustments were not, the reason why I did those adjustments were get the deltas back in line, because I knew we were going to hold it for that big event. And I didn't know. In fact, I didn't think it was going to move this far, and that's what it did. It moved really. I mean, we moved almost, what, $2 a barrel for that big event. It surprised me. I thought we would stay within a $1, $1.2 range, but we moved lower, and then after that, we continue to go lower. Now we're in this choppy range here, right? So those adjustments proved beneficial to us. So now, but we're in profits today, and we're going to look at it, and we'll probably end up holding it through Monday or Tuesday, and then we'll look at getting out of it at that point in time. Okay, so that's kind of where we are in the oil market. But that's why I'm just like, Goldman Sachs, give me a break. You know, Goldman doesn't. You know, they're clueless. Actually, they're not. They're very smart. I know folks at Goldman because I've worked with them before. But they're smart because they've got their reasons for wanting you to think long when it's short, right? So anyway, that's oil. And then looking at it on a 2-hour chart, you can see here this move back down on the 2-hour chart. It's very choppy, right? I mean, these counter trend moves are choppy as hell, but it's clear that we're making lower lows and lower highs. I mean, that channel is about as clear as you can get, guys. And until we can break that channel and start to make higher highs and higher lows, I'm still into that kind of game right there. That's why when we set this trade up for the first time last week, I set it up with a bearish bias, okay? Because this is what we're doing here. So I set it up with short delta going right into the trade to begin with. So that's oil on a 2-hour chart. If we come in here and we look at, let's go look at some of those trades that you want to look at. So let's go take a look at some of those. Bear with me 1 minute here. So let's go look at Amazon first. And you can see here with Amazon, all right, let me just put it like this. Let's make it out like this. And the question is that a bearish flag? Well, no, there's really not a, if you look at this, a bull flag is, and there's the trend line. A bull flag is if it moves up and then does one of these things and stays in that kind of pattern. This is down, and you could almost call that a pennant, but don't get too wrapped up in what the technical term is. But this would suggest further downside breakout. So your original bias is correct, even though it's not called a bearish flag. All right, but it doesn't matter. This would be a bearish pattern. Now notice how the 50 EMA, even though we moved below, let me just elongate it just a little bit here. Even though we fell below the 50 EMA, the 50 EMA is a big holding point where it looks like big money wants to come in and just pick it up. So you could probably say that the 50 EMA is a valid area here for support. You can see one area right there where we had support. You can see right there where we had support. You know, this area right here is at the 940 right level, and this down here is at the 890 level for Amazon right here. So these are areas, and you can also see that's where the volume is right here. So it would not surprise me to see Amazon come down in this area here and retest that. If the markets continue lower, that's what's going to happen. And this would be what you'd call a bull trap, where it wants you to think it wants to go bullish like that, but it's more of a pennant where it would break back to the downside, okay? If we zoom, and this is a daily chart, let's zoom into a 2-hour chart and see if we can get a little bit more clarity on it. If we look at a 2-hour chart, well, clearly on this 2-hour chart, this is more bearish, right? You've got this initial pattern here that looks like a 3 and a 4 and a possible 5 somewhere down here, right? So the key for me is if we take out that low, right, this pivot low right there, then we're going to go much lower. All right, we're going to go much lower. So that's kind of in the near term, and you can see in pre-market hours, let's put it on a 15-minute chart. So the pre-market, before the market opens, you can see where it's going, right? We closed yesterday at 976. We're going to open today at 961. That's what, a 14-point drop at open? So before the markets even get going, Amazon's going to open down 14 points. That in turn is going to, if we go take a look at some of the others, let's go look at some of the big ones. Let's go look at Google. That's the other big one. Google, it closed yesterday at 967. It's going to open at 951. So another 14, 15, 16 point drop at open. All right, so that's another one. That's one of the other FAM stocks, I guess. Let's go look at another one. Another one would be Facebook. Look at Facebook. It's going to open here around 148. It closed at 150. So it's going down a pretty good little bit. Let's look at Microsoft. It's part of this group that have led the way up. Microsoft closed yesterday at 70.27. Today it's going to open at 69.56. So down, not as dramatically as the others, but still down in the red, right? So that's going to gap down in the morning. The other one is Apple. Let's look at Apple. If Apple, in pre-market, Apple closed yesterday at 145.16. It's going to open this morning, or at least right now, at 143. So down about 3 points. So every one of these silo stocks that make up over 50% of the value of the NASDAQ 100 futures are going to open lower, which is why we get the NASDAQ futures, because these guys control, you know, such a large percentage of those, which is why we're going to get NASDAQ futures is going to open down right here. About, looks like right now it's down 57 points, down over a full percent. Okay, that's going to weigh on the markets, and who knows whether we're going to get a bounce or not, but we got to watch these things very closely. We're getting a 345 and a 5 print on the 15-minute NASDAQ. This is a poor man's bud, so that would suggest that it favors upward price action, but what you got to be careful of here is being sucked in, right, where you get this move here, but then that would be just an A leg print after a 345, and then you get a B leg print, and then you get a C leg print, And then where these pivot points wind up is going to determine, is it going to give us a new channel to the upside like that, or will these things end up where we go A, B, C, and then it gives us a continuation of this right here. So you don't know. No one knows. The odds favor right now this pattern here, where you still get the ABC pattern, but it says we're going to make another pivot low lower than that low right there. All right, now this is on a 15-minute chart, so this could print out today into tonight, and then everything could all change tomorrow. I don't know, but that's what it would suggest for near-term action. Okay, so those are some of those key stocks. If we look at Zion, because we jumped into Zion, right? And let's come back to a daily chart here. You can see Zion, it's a banking stock. You can see here like that. It's in the process of forming a cup and handle, which would mean it would come up, come down, come up, break that level, and then the pattern suggests another 10% move from that point right there. Okay. And if you look at my resistance point here, if I put everything back on the screen and I measure that like that, it shows that the upside is around 50.35. Okay. So we jumped into Zion. Now, if we look at pre-market to see how it's going to open today, we don't get enough data on Zion to be able to do that. So it's not as actively engaged in pre-market. You can see this 15-minute chart. We actually sold off during the day yesterday, but we closed up 10 cents from the open. So Zion, even with all that crap yesterday, we actually closed up 10 cents. Okay, so I'm okay with Zion right now. Now remember, we're trading IWM, which is the Russell, so I'm not going back into the Russell because I showed you where we are with the Russell. Some of the other ones, NVIDIA. I want to go long NVIDIA, but I'm waiting. As I said before, guys, and I know some of you are just kind of, it's okay if you want to go in with a very small amount, but I think it's going to come back down and test the 142 area again because it's had such a run up here. And then that sell-off last Friday kind of scared the children in some of these high-flying stocks until these things rebalance. If we look at the 15-minute chart on NVIDIA, right, we closed yesterday almost unchanged for the day with NVIDIA. But guess what? We closed at 151. Today we're opening at 146. It's going down lower. So I'm waiting for a better entry on NVIDIA. I do want to go long that stock. It's a great company. This is why we like pullbacks, because pullbacks take great companies that you want to be long in and get you a better entry price. And that's what I'm hoping for. And our anchor trade, which is the SPX flies or super birds, if you're a portfolio margin member or trading, they give us the anchor, the 60% of our net lick, where it doesn't matter what the markets do, we can adjust it and then make money out of it. All right, so that's the anchor. But these are some of the other ones that we start allocating some of our other portfolio with. The other one that I liked that is in the tech sector is Lam Research, LRCX. This guy in pre-market action, it looks like a little bit, but it's going to open a little bit lower, right? Same thing with this guy. I love this stock, but it almost looks like NVIDIA, right? It's a great stock. But again, in this one, we had a poor man's bearish divergence, right? We had a high here and a higher high here. But I do like this area here, and we're going to be loading up to go long some of this stuff. Yeah, cocoa. So remember with cocoa, and as I said, we're going to use some of the ETFs to trade some of these things. Here's cocoa. It's flat right now. It is just literally flat. I think we can go on for a bit in this. The way we would trade cocoa is trading the ETF NIB. All right, it looks just like cocoa. It is, in fact, it's the Bloomberg Cocoa index. So we can trade the ETF NIB for cocoa. It'll make a run, but not yet. It's not ready yet, in my opinion. Look at sugar, guys. Now, we shorted the snot out of sugar. And then we got out when the damn ice. Remember what we were doing with sugar? We were short up in these levels here, and then we got stopped out there. We got short right here, and then right in that area there was when they, or right in this area here was when they stopped offering sugar trades. So, but we made some good profits in that run there, and we made some good profits in this run here. But look at where sugar is now. This is why when you get these moves here, now this is the trade where we made a killing on, just like we did in orange juice. For those of you that were around that were following me in these trades, you know we made a lot of money in this thing. If we look at sugar, the ETF, the Bloomberg Index, SGG, we could have done the same thing, but at this point I was trading the actual futures market, but we were trading SGG, and we would have shorted SGG, and we would have shorted it around the 52 level, and now it's around 29, right? We probably would have been stopped out, and rightfully so right there, but we would have jumped right back in right there again and rode it back down, okay? And I will tell you the number of shares to short to give it the notional equivalent of a futures contract, all right? And it varies depending on where the price level is. You know, it may be 700 shares, it may be 1,000 shares, it may be some odd number like 485 shares, but I'll tell you the notional value. And for those of you that like trading the futures, but you can't trade it because it's not offered in ICE, you can do it with these indexes right here, long or short. I'll give you the notional value. And for those of you that like to follow along, but you never like the amount of risk associated with futures, you may say, well, if that's the notional value, meaning that's how many would equal one futures contract, I'll do half or a little bit less than half, or I'll do a quartile or something like that. So it gives you an opportunity to play with our trades because we've been successful in these things. And I do love the imbalance that we saw in the sugar market and the imbalance we saw in the OJ market. That's why I took those trades. All right, everybody, I've kind of run a little bit longer than I thought, but I wanted to cover some of these things as well as some key stocks that we're looking at. Guys, have a really great morning. I'll see you in the chat room in a bit, okay?